Welcome back to Run the Numbers, the podcast where we make finance a little more fun, or at least more tolerable. I'm CJ, and today we're diving into a question that has changed dramatically over the past decade. How much revenue do you actually need to IPO? And so it used to be that if you built a good company, solid growth, and had decent unit economics, you could go public. But today, the bar has been raised pretty high, actually. And so, first, I want to take a look back at the 2010s and the IPOs we historically saw. In the early 2010s, you could go public with much smaller revenue levels. So you had the likes of RingCentral in 2013; they had 99 million in revenue, believe it or not. You had 2U in 2014, 100 million. Etsy and Box in 2015, each around 240 million. Now, these companies were early movers in their industries. You had RingCentral riding the wave of cloud based communication, Etsy bringing the artisanal e commerce niche to Wall Street, and Box part of that early SaaS boom where companies could IPO while still deep in the red so long as they had a path to scale. But back then, the median IPO revenue hovered between 100 million and 250 million, and that was enough. But by the late 2010s, things changed. Investors started expecting bigger numbers, stronger growth, and clearer profitability paths. So I want to skip to 2021. That was a magic year. You might remember being locked down and just seeing everybody and their mother doing an initial public offering. There were a record 1,035 companies that went public globally, but this wasn't just about quantity. Some of the biggest IPOs of all time happened in 2021. You had Coinbase, 1.3 billion in revenue at IPO. They were riding the crypto boom and they went public via a direct listing and quickly hit a market cap of nearly 86 billion on its first day in trading. They're actually still below 100 billion today, which is interesting, even though their revenue is more than tripled. It was one of the largest debuts ever for a fintech company. Y Combinator. Ooh. Snowflake, 592 million in revenue at IPO. A cloud data powerhouse. They had a blockbuster debut with Warren Buffett of Berkshire Hathaway even taking a stake. If you remember, Berkshire Hathaway was on the cover. That like doesn't happen. Berkshire Hathaway is not known to participate in IPOs. Airbnb. Oh, another Y Combinator, 3.4 billion in revenue at IPO. So despite travel taking a massive hit during COVID, they rebounded hard and went public at the end of the year with one of the most anticipated IPOs of the decade. If you remember, nobody traveled, and then everyone's like, "Can I get an Airbnb in Vermont?" Right? So they went public at the end of the year. Then DoorDash. Oh my goodness, a third Y Combinator company, 2.9 billion in revenue at IPO. That's a lot of watermelons to deliver on bicycles. Unit economics don't matter, right, guys? Fueled by the pandemic driven food delivery boom, DoorDash went public with massive growth numbers. Questions did loom about their long term profitability, but its IPO, it was a massive success by all measures. And so at this point, the median revenue had skyrocketed, right? The revenue you needed to IPO used to be 250 million. Now the threshold was 500 million plus, and companies raising billions became the norm. So remember, the amount you raise is directly related to the valuation you have and therefore the dilution you take on that raise. So before, companies were raising, between I don't know, 100 million, 200 million. They were using it more like what you see as a primary late stage fundraise today than the IPOs we know of, like Snowflake raising over $1 billion in their IPO. That was crazy, right? And they still had to give up like only less than 10% of the company dilution wise. So 2022, 2023, the IPO freeze. Hell freezeth over. The music stops. Interest rates go up, growth stocks crash, investors get skittish, and suddenly the IPO market dries up. In 2022 and 2023, we basically had no major IPOs because the companies that would have gone public at 200 million in revenue, they weren't getting the valuations they wanted to get a market cap high enough and a valuation that would make sense, right? I can't raise enough money, and if I try to, I'm going to get the hell diluted out of me. So some companies that IPO'd in 2021 faced brutal corrections. You had a firm, they soared to $168 per share, only to crash below $9 in 2022 as interest rates grow. Interest rates rose and growth stocks fell out of favor. But here's the thing: a firm has actually rebounded to over $75 since then, while some other high growth fintechs didn't, like Blend. For 2 years, companies that could have IPO'd stayed private because no one wanted to debut in a brutal market, right? Too cold to go outside, like in Connecticut right now. 2024, the rebound, but with a higher bar. So now you look at 2024, everybody's like, we're back, but only if you're big. So Reddit, 804 million in revenue. Klaviyo, 585 million in revenue. Rubrik, 628 million in revenue. Instacart, 2.9 billion in revenue. Wow. These numbers aren't just higher than pre-2021, they're double what used to be normal. Woo! And then we have OneStream come along. They IPO'd in 2024 with just 407 million in trailing 12-month revenue. And so they were testing, did a brave thing for everybody, if the market is finally willing to entertain smaller IPOs again. And based on what they're trading at today, I'd say doing pretty damn good. And as of Thursday, SailPoint, the cybersecurity firm going public for the second time. If you liked them the first time, you're gonna love them now. Under Toma Bravo, they're at 700 million in GAAP revenue, a little over 800 million in ARR. So it feels like we're honing in on that 500 to 700 million range as green means go. All right, guys, what comes next? The 2025 IPO watch list. So we've covered how the IPO bar has risen and how 2024's crop of public companies is setting a new standard. But what about this year? There's already a strong lineup of companies rumored to go public. Based on valuation and revenue estimates, I'm grabbing from position.so, you get Deel, HR and payroll software. They're growing at 70% year over year, and they're at over 800 million in revenue while being profitable. Woo! Databricks, AI powered data analytics. They're a Snowflake competitor. They're sitting on over 3 billion in revenue and at a $62 billion valuation, according to Position. Canva, the design platform, has surpassed 2.5 billion in revenue. The pride of Australia. It could be a massive IPO. Anduril, defense tech company, they're on pace for a billion in revenue this year. They're a rare play in national security, over $14 billion valuation. Challenging the primes. Ooh, bold move, Cotton. We'll see how that shakes out for them. Stripe, one of the most anticipated fintech IPOs of the decade, if they finally decide to go public. TBD, they're valued at over 70 billion, doing over 4 billion in revenue. Klarna, the buy now, pay later giant, they might make a major splash in European markets. They've had that topsy-turvy run at things with a valuation that went all the way up to 45 billion, then back down to 6.7. But they do have over 2 billion in revenue and they could make a move. That's a lot of scale. CoreWeave, cloud computing company growing rapidly due to something called AI. They're valued at 23 billion and doing over 2 billion in revenue. Chime, a leading neobank, and they're actually B2C. The other ones I mentioned were all B2B. They could finally go public in 2025. They're valued at 25 billion and doing over 1.5 billion in revenue. Last one, Cerebrus Systems. I can never pronounce this one. Cerebrus. AI hardware riding the AI investment wave. They're getting up there and they could go public. So if these names make the move, we'll be looking at another big shift in the IPO landscape. You get to focus on AI, fintech, and national security. And if you notice, all these companies are now honing in on that closer to $1 billion in revenue range. So I think the bar is actually going higher. And so here's the rub. I used to be of the mind that you could just build a good company, grow nicely, have solid unit economics, and IPO at 100 million in revenue. That was like the Twilio playbook. And you can, but you're fighting an uphill battle to thrive in the public markets, which partially trade on attention. So to get coverage from sell side analysts and actually move the needle in institutional portfolios without requiring investors to take massive positions, you need a market cap of at least 5 billion. Some would even argue 10 billion plus is the new standard. And we've talked about this in depth before. Size matters. And to tie that back to revenue, if you're lucky enough to command a 10x valuation, and that's looked at as premium, right? Like the median tech company right now is trading at around 6x forward revenue. The top 10 are trading somewhere around 18. So 10x is really healthy. So you would need at least 500 million in next 12-month revenue to get to that valuation. So could we ever see a return of the days when companies like Wix, HubSpot, Appfolio IPO'd with sub 150 million in revenue? Perchance, but right now the new rule is clear. You want to IPO, bring at least half a billion in revenue or a damn good reason why you deserve to go public. So that's our deep dive today on the state of the IPO markets. If you like this episode, hit subscribe and send it to that friend who still thinks an IPO is just about ringing a bell and throwing confetti, which also does look fun. Until next time, peace.